Welcome, everyone. This is the Northern Virginia IBD Meetup. And this session, we are super lucky to have Dr. Wish, the famous Dr. Wish, present to us. So I've heard him so many times at the AAII group, as well as seeing him in person for so many years. So with that being said, I'm going to hand it over to Dr. Wish, and this is going to be a phenomenal presentation. Thank you. Thanks for presenting, Dr. Wish, by the way.
You're very welcome, and I hope people will stay awake. But if I put you to sleep, you can watch the recording some other time that you have insomnia. Anyway, I really want to thank you for the privilege of addressing your group. I felt a little intimidated because I know, Vas, that you have been leading this group, you're director of education, and you've been teaching them some amazing stuff. So I'm assuming that a lot of them are well grounded in technical analysis, so I may go over some things rather quickly, but you can replay it on the recording if you want to look over what I'm saying. Vas has come to my class to give a lecture every semester that I've taught, I think at least 15 years. And when he comes to the class, I always tell the students that they've been learning Dr. Wish's approach to the market, and there's a whole nother approach. There are many approaches, I say, and Vas will come in and won't use the indicators that I use and has some amazing approaches that I have learned a lot about from him. And tonight, later on, I'm going to apply my approach. I did this once before and had the same results. Basically, I'm going to apply the indicators and the setups that I'm going to show you today to his work. And lo and behold, they are so associated, so correlated. And that's what you would think so, because if my approach makes money and his does, there's a good chance that we would be zeroing in on the same stocks, or at least at the same setups. I ran a research center on drug abuse called Caesar at the University of Maryland for 32 years. I stepped down in January. And at the same time, I've been teaching this course. It's now Ensuring Your Financial Future Through Stock Investing. I've been teaching that for about, I'd say, almost 18 years now. And I teach it once a semester. And I have about 100 students in the class. And I am now moving towards retirement. I will be teaching the course next fall at the University of Maryland. And then I am supposed to retire in July the following year. And we'll see what I'm going to do afterwards. I just don't know yet what I'm going to do. But why I teach is I teach people what I wish someone had taught me when I was their age, because I had to learn this myself starting in the 60s, and I didn't have anyone to teach me. So I read books, which I'll tell you about. But there's such a crying need for financial literacy education in our country. When I mention to even grown professors what I teach, they all say, "Can I take your course?" Which they can't, of course. And the course is now, as I said, it's taught once a year. And the Worden brothers from TC 2000 and the Investors.com people from MarketSmith and Investors and IBD, they make all of that available to my students for the semester, so they can learn how to use these tools. When they leave, they know how to use these tools to assess the market. I think the most difficult thing tonight of everything I'm going to say is my accent. I have a Boston accent, so when I say CHART, that's chart, okay? And if you want to learn how to speak proper English, just listen to me, because I'm a Boston accent. Anyway, I will share what I've learned. I've made every mistake you can, and I've been able to do reasonably well and succeed in the market. And what I say to the students and to you is, take what I say and try it out. What works for you, what makes sense for you, use. What doesn't, just discard. Okay? You don't have to agree with me just because I said it. I want you to actually be your own scientist and figure out what works. Okay? And I'm really excited today to share, because partially from the analyses I did of Vasa's presentation from last semester, I came up with a new setup that is just phenomenal. And I'm not one to brag. And all I'm saying is, for me right now, and I know it's a great market, so you know that what they say, in a strong market, everyone looks like a genius. But I can tell you, from having done this for so many years, the setup that I developed, which I call a blue dot setup, worked tremendously. And I'm looking forward to using it more, and I hope some of you might value from it and try using it. So with that, let's get going. I hope I haven't lost too many people. This is David McCandless. He was my co-instructor. He knew so much about IT. A lot of the things I'm going to present, he created. And 2 years ago in February, he and his daughter built a boat and went out outside of Baltimore on a very windy day. The boat capsized and they swam to shore, and he died of hypothermia. He also had a heart issue. And it was very hard to make up for this, because I relied on him to do everything so I could just show up at the class. And he was brilliant analyst. And I just want to tell you some of the things I show you today, including the next slide, were things that he built. He had a great sense of humor. And since he left, I found a new right hand, someone who works with me on my research projects, named Amy Billing. And she has done a phenomenal job figuring out, from what David left, how to basically design the things that I was used to. And she helps me to present the class each semester. So with that, this is David's slide. And basically, you may recognize this. I thought it was Enron, but it says it's another stock. But anyway, I just want to tell you that I am not an advisor. I don't know your financial makeup and your risk tolerance, and I'm not giving you advice or recommendations today. This is all educational purposes only, and I'm hoping you will take it and adapt it for your use. Okay. So, looks like in 2009 here, IBD published an article about, in their Real People, Real Success column, talking about what I had done. And then, I think Vas mentioned AAII. I used to go to AAII meetings. And this is one of the examples of the brochures they would put out. And then in 2019, Les Masonson, who is also a great author on the stock market, and you can look up his books. I think one of them is Buy, Don't Hold. Anyway, very good book. And he did this 10-page interview with me, which, again, if you're having insomnia, you can read it. It'll help you to fall asleep. But if you want to know why I got into this, what my family background is, all that, you can try and get this chapter from the Task magazine. All right. So in 2005, as I say, I've been a research professor doing really innovative research projects for the country on drug abuse. And but I also traded on the side. And I took a chance and entered the Barron's Stock Market Challenge, it was called. And what they did is you signed up for a virtual online account, no real money, and you traded. I don't remember how many months it was, but basically I entered, even though I didn't teach, I entered the professors division. And you can see over here, I came in 5th in the country with a 30.8% increase. I was using CanSlim methods, which most people weren't probably back then. And I almost came in the top 10 the second time when I entered. I just missed it by 1 or 2 people. But, I was looking at this tonight, and look at the students. The students did better than the professors for the most part. And that maybe there's a message there, but I think really what it is that there were a few college professors competing, but when you had probably thousands of students competing, some of them by chance are going to do a lot better. And maybe that's why, or maybe they knew how to trade better than the professors. I don't know. Because I once went to lunch with someone from the business school at Maryland, and I had lunch with him, and I told him what I did, and he says, I don't think you should teach it. So what I teach is so different from what the business school teaches, which is very, asset allocation, very sophisticated stuff. And that's not what I teach. I teach practical stuff, how to make money. And I actually had one other professor I talked to, used to work with me. When I told him what I did, he says, I don't think you should teach it. It's too practical. Anyway, I went to the honors program where I had been teaching a course on drugs in American society. And I said I have the second passion, and I showed them this result to give me credibility. And they said, write up a page about what you want to do. And they, in a day or so, they accepted it. And I started teaching an honors program for the best and the brightest at the university. It was 20 students. It was a phenomenal experience. And then the honors program reorganized, and I couldn't teach there anymore. And I started teaching this group called Freshman Connection of about 100 students. And the reason I teach it is I don't make any money from this. All the money that was made from my teaching went to my research center so I could support people to do the research. All right. So this is what I teach. And it takes 14 weeks to teach a class of students what these words mean. And I revised this, as you can see, just a few days ago. So I think it's clear. And basically it's in an uptrending market by rising visionary rocket stocks that are oversold and turning up, or that are breaking through resistance, preferably to an all-time high on above average volume. When you think about what I say there, and you think about what all these gurus teach, this really boils down to what they're teaching. They're basically saying buy stocks that have shown some evidence of strength, that have risen, and that have rested in a base and are now breaking out. Anyway, as I say, it takes 14 weeks for students to really understand this. All right, I start off assigning How I Made $2 Million in the Stock Market by Nicholas Davis. If you haven't read this, it's a shame. Almost every guru has read this. It changed my life. I read it in the 60s. Instead of buying stocks at new lows, instead of buying stocks at low PEs, I all of a sudden was buying stocks at new highs. And so I urge you to read that book and the follow-up book, Wall Street, the Las Vegas, in which he compares at the beginning, he compares brokerage firms to casinos. And because of that, Barron's and all the Wall Street wouldn't accept ads for this, when in fact, for this book, when in fact his first book put Barron's on the map. That's how I heard of Barron's, because Davis, who was dancing around the world as part of a famous duet, taught himself how to make money in the stock market. And he used to get Barron's, and he would tear out all the opinions and just take the prices, and he would look at those in order to choose his stocks. And so I highly recommend, if you haven't read it, read it, because it's a great introduction to the market. And by the way, Alan Ellman has the Stock Investing for Students, which is a fantastic book for someone, a young person that you want to introduce to stocks and the market. It's fundamental analysis, it's technical analysis. It's not too deep, and it's a great introduction for someone in high school or college. So they read How I Made $2 Million. Then I have them read a chapter from Stan Weinstein's book, because Stan Weinstein created stage analysis, which is a phenomenal way of tracking trends in stocks. I have them read the chapter, and Trader Lion, Richard Moglen, has interviewed Stan Weinstein and created a course on Stan Weinstein. So he's still alive. He's an old person like I am, and you might want to hear him from his words, how he uses stage analysis to trade. When they get done with that, I take them to William O'Neill's book, How to Make Money in Stocks. And that's the Bible of the course. And they learn Can Slim. And they then, after about 4 weeks of reading almost 1,000 pages, they're ready to start trading a $100,000 margin account. Each one has their own account. It's the same type of account I traded in the Barron Stock Challenge. And they basically apply their own setups or the setups I give them to trading stocks. And then they write a report analyzing their portfolio. Anyway, in addition, and this came out later, Mark Minervini, who, by the way, came to my class, both the honors class and gave out books, and then the bigger class, he came online. I call him a modern day Nicholas Davis. I went and did his workshop, his 3-day workshop in Myrtle Beach. I told him that he teaches in 3 days what takes me 14 weeks, and he teaches them even more. And I would urge you to read his book at some point. In addition, John Boyk, who has written these 2 books here, Lessons from the Great Stock Traders and How Legendary Traders Made Millions, he came to my class last semester. These books summarize what these other traders have done, and it's a really good way of catching up on that. And also, Alan Ellman is really well known for covered calls writing, and you should go to his site if you can, Blue Collar Investor, and you'll learn all about that. So, and this is the second book that Mark Minervini wrote. And believe me, he trades like a business. I think you all know that he's U.S. investing champion twice when he entered, made huge returns. I recommend his book too. This is Mark. This is our thanking Mark in the class. There is me, myself, and there's the late David McCandlish, when we all thanked Mark for his contributions to the class. When I met him, he really was really taken over by meeting me and hearing that I was teaching people in college these types of issues. Okay, what I'm going to do today, I'm going to talk about the market trend and my general market index. I'm going to talk about green line breakouts, or GLB, stochastic indicators, stochastics as applied to VAS's setup, and then I'm going to give you all a homework assignment, and then I'm going to finish with the TQQQ beats all of these things. Well, not the stuff about VAS and the new setup. All of these have been mentioned in my blog. So those of you who go to my blog, you get a good idea of what all those terms mean. Okay, so why is the market trend important? When I went to an AAI meeting in Virginia, and this, I think all of you old folks will understand this, you young people won't, but I remember going there and thinking, gee, I used to have to go to a map and draw on a map where I was going, and write down, turn left here, turn right there, and whatever, and have that as I drove to it. And so when I went to the AAI meeting and just used Waze, I said this to the audience. I just said, buying a stock without checking its chart is like driving to a new place without Waze. You need a chart to tell you the stock's history, its trend, where it's likely to go. All right. Even the great Nicholas Davis, listen to what he said. He said he used to track the Dow Jones at average because that's all he had in the 50s, in a sense, to track the market. He said, I realized that a general market cycle influences almost every stock. The main cycles, like a bear bull market, usually creep into the majority of them. All right. So some readers, some people read his book, and in one of his later editions, they had questions and answers. And they said to him, do you know, if you got out when you got out of stocks and just shorted them, you would have made a lot more money. And he wrote this, which I think is very important for people to understand. He says, of course, there are exceptions to the rules. There have been any number of stocks that have multiplied in price manyfold in a bear market. Just there are plenty of stocks that have hardly moved in a bull market. But my temperament is such that I prefer to be safe than sorry. So I keep out of a bear market and leave such exceptional stocks to those who don't mind risking their money against the market trend. Now, I would add to this, if you're really good at knowing the market trend and you're in a downtrend, you could short. But he only bought stocks. So he's saying, I want the market to be in an uptrend in order for me to buy stocks. Okay? Now, also, you know all what CAN SLIM is. I'm not going to go over this, but remember the M. The market indexes is a major thing that you want going for you as part of the CAN SLIM approach. And This is a quote from William O'Neill's. You know, he says you can be right on every individual stock factor, but if you're wrong about the direction of the general market, 3 out of the 4 of your stocks will plummet with the market averages, and you will certainly lose money big time, as many people did in 2000. Therefore, in your analytical toolkit, you absolutely must have a reliable method to determine what direction the market is headed. The key is to follow, interpret, and understand what the general market average is doing every day. So how do you do this? Well, I want one more point. I sometimes quote myself in my class. And I said, you know, I've been doing this for all years. And what I found was the critical point to remember is that the same price pattern that works so well in a rising market is likely to fail in a declining market. I think all of you must have had an experience where you came out of a bull market, you knew what setups will work for you, and you kept doing them when the market trend turned down, and you lost money. And in fact, what Davis said is when his setups stopped working, it was a good indication that the market was turning. I believe Mark Minervini says the same thing, by the way. When he all of a sudden finds that his great setup that he likes is no longer working, beware. The market is telling you something. All right? So I want to show you this because I feel real strongly that I tell this to the students, but you all should just know this because stockbrokers try and scare you into the market. And by the way, I tell the students at the beginning of the first class, first I ask, is any of their parents a stockbroker? And then I say to them, please forgive me, but they're well named because your broker will make you broker. You know, I can't tell you the amount of money I lost in the early days by listening to stockbrokers, you know? So if you go into a stockbroker and you say you try and time the market, they're going to tell you, no, you can't do it. You know why? You see this gray line? This is over time if you stayed in the market. This is how much money you would make, all right? But see the red line? If you missed the 25 best days in this period, look how you lost out. You made very little money. They never showed you the green line, which is what happened if you missed the worst days. So avoiding the worst days in the market and the worst times in the market can really help you out. And by the way, I don't like these analyses because I can't imagine how over a long period anyone could be so bad to just miss the 25 worst days. Do you know what I mean? Yeah. What do you mean? Are you out the whole time? It just doesn't make any sense, this analysis. But I wanted to tell you this. All right. So how do you assess the market trend? The indicators for me for determining the market trend a stage analysis of the indexes, and that I told you, you can go to Stan Weinstein to learn that. Guppy charts I oftentimes look at, and those are not fish. Those are Darryl Guppy, who is the technical analyst, the chief technical analyst in Australia. He's written a book on this. You can find it on my list there. I don't recommend his books unless you just want to find out how to do the Guppy charts. Okay, but I do adapted Guppy charts. Then there's the general market index, when I'm going to talk to you. It's on my blog. And then there's T2108, which I'm not going to really talk about it, but I show that number every day that I post. Because if that number gets into single digits, look for a market bottom. All right? And you can go to my blog to see examples of that. Then there's the IBD, investors.com, MarketSmith Market Pulse. I'm going to show you in a minute, which you get from IBD. And you can also get on IBD and contextual indicators, which is investor sentiment and the put call ratio. I'm not going to talk about those. All right. So here's the market pulse. They changed it. This was as of the 23rd of this month. And now, in addition to saying the market's in an uptrend, they give you a recommendation of how much exposure you should have in the market. Okay. I look at this and I keep up on this. And I also sometimes look at their leaders, because this is a good list of the stocks they think are leaders. Okay. This is my general market index. I publish this on my blog, the numbers, every time I publish, and I publish this chart every weekend. Okay. Now, the GMI counts 6 indicators, whether they're positive or negative. These are things that I've developed over the years, and I put them into this, and I'll show you how it works. But basically, I'm not going to go into all of them, but basically, like one of these measures where the stocks that hit a new high 10 days ago are higher now than they were 10 days ago. I want at least 100 new highs out of 6,400 roughly US stocks, because if I'm using a strategy that buys stocks at new highs, I want to be in a market where there are a number of stocks, large number of stocks hitting new highs. I have a daily QQQ index, a daily SPY index. I have a weekly QQQ index, which is based on analysis, Weinstein stage analysis. And then IBD used to publish, it still does it, in investors.com, and it is on MarketSmith. If you type in on their charts 0 MUTI, you get this index. And this index shows you how, I think it's about 20 growth mutual funds in their index, how they're doing. And I found that that should be over the 50-day average. If it isn't, I'm not going to do well. The types of stocks that I buy aren't going to do well. So I want that to be true. I created this GMI2. You can ignore the number because some of these are not even correlated. They're just every night after the market close, I fill out all these stats. And so these are just things I want to know. They have some very sensitive indicators in here, very short-term indicators, even stochastic indicators. And it just helps me to be aware of it. I also have the QQQ short-term trend count, which I usually list on my blog every day. It was at this time it was U13. It's probably U16 or so now today, since you got 3 days after Sunday, okay, after Friday. I also talk about how many weeks the indexes are above their 10 weeks averages, which are very important. Here's the Worden T20 White indicator again, which was 55%. And anyway, that's all I'm going to talk about. So this, I take the GMI and I basically say, if it is above 3, that means it's 4, 5, or 6 for 2 days in a row, that indicator becomes green. And it turns red when it's below 3 for 2 or more days, okay? So I have a green and a red signal, and I wanted to show you how the GMI corresponds to the QQQ. I'm focusing on the QQQ because that's the type of stocks, they're basically non-financial growth stocks, which are the types of stocks I teach about, and the types of stocks that IBD and MarketSmith are talking about. So here you can see, this is going back to when I started. Notice in 2008, I was out of that whole market. Look at this, red. And notice in the 2020 pandemic market, red. Now, it gets me out at a good time. It oftentimes doesn't get me back in at the bottom, but you can decide how to use it. But you can see. So this is one chart of it. This is a shorter period, so you can see even better. Here's the pandemic market. Here's the horrible year we had in 2022. And you can see we've been green a long time since, 2023 here. Okay. And this is even shorter time. You can look at this later on the recording to give you a good idea. So, I've realized that if the GMI is green, then buying the types of stocks with the types of setups I like works. When it is red, it's really difficult to make money, at least for me, on the long side. Okay, here's an example of a recent post on the 28th. This was on Sunday. The GMI was 6 out of 6. Ignore the GMI2. The T2108 was 55%. And by the way, T2108 measures the percentage of New York Stock Exchange stocks that closed above their 40-day moving average. That's all it is. And I told you, when that gets below 10, look for a bottom. Okay, when it gets near 80, the market usually is too hot. All right. So here's what was the title. It was green. And I also mentioned this table over here, the successful GLB tracker table. You'll understand this more later. But basically what that does is tell you stocks, selected stocks that had a GLB and a successful GLB. It is not every stock that has a GLB. I have people emailing me and saying, well, did you add this stock? Did you add that stock? I'm just basically making the point that a GLB setup, which involves buying stocks at an all-time high that have rested and going to an all-time high, can work beautifully. And I'm going to show you that in a minute. Okay. So the same post, you see, it says blog post day 13 of QQQ. This is what, if you go to me on Twitter, you will find the title of the blog here, same thing. And you can click here to go to the blog if you want. So you can follow me on Twitter if you want. Sometimes when a stock has a breakout, I will tweet it out intraday. Okay. Now, this was Tuesdays. This is Wednesday. So Tuesday's, yesterday's post. And I just want to tell you that I happened to notice that SMCI had a recent green line breakout. See the green line, the breakout on above average volume here. And so I wrote about it just again to talk to people about the tracker table. And when I wrote about this Tuesday night, this stock had been up 43.7% since its green line breakout right here. And now if you look at the current, this GLB tracker table is more current. It has today's close. Notice that the stock that I said was up 43.7 is now up 49.38%. It went up something like $16 today in a horrible market. This doesn't always happen, but I just wanted to illustrate this. Okay, so green line breakout. You know, I show this to students over and over again, and they still get it wrong, and we have to correct them. So listen closely. Okay. First of all, Nicholas Davis was asked in the appendix of one of his books, it says, when you use a historical high as a buy point, do you hold literally to the historical high? Or can you buy safely a stock making a new high for a lesser period, like 5 years, that also shows stepped up volume? Look at Davis's answer. This is the guy that is a guru that a lot of people follow. I strictly adhere to historical high. You know, when I used to go to AAII, which had a lot of gray hairs like me, I would start off the meeting and I would say, raise your hand if you buy stocks at a 52-week high. And I would get maybe 10 out of 100 people. And then I would say, how about at an all-time high? And maybe I get one person. And then I would say to them, I like to buy only stocks at an all-time high. So how can that be? Well, look, if you want to go get us on board a stock that's going to go to the moon, doesn't it have to keep going higher, higher, and higher? That's where you look for the new leaders in the high, all-time highs, in the new high list. Okay, so that's what Davis said. And I want to just show you that Nicholas Davis, this is the Dow from 29 to 56. And this basically is the green line at the peak. This is a monthly chart. You see this green line breakout right here when it went to an all-time high, the market went to an all-time high. That is when Nicholas Davis made his fortune dancing around the country. In addition, when people ask me, does the market always come back? I say yes, but after 29, it took 25 years. So just be aware of that. All right. So this is what the market looked like, the Dow looked like on a weekly chart when Davis made his fortune. Look at that. Okay. In addition, and I'm not taking anything away from him, Mark Minervini made huge gains 2 times when he entered the U.S. Investing Championship. So I went back and looked at the averages. They were hitting a series of all-time highs. So the huge gains, even among the best traders, often come when the market is hitting all-time highs, which we've had recently, by the way. Okay, so I also like this quote from Burton Crane. There's no magic about buy signals. They're only devices by which we call our attention to stocks that have already begun to attract the attention of others. And I tell my students, you don't want to be a pioneer in the stock market. You want to find stocks that the people with deep pockets are already buying. They've already discovered it and they're buying. And that's when you get on. Okay. And that's what I'm talking about tonight. So how do you draw your green lines? First of all, you draw it on a monthly chart. Now, once it's drawn on your monthly chart and you switch to a weekly or a daily, it'll show up. But you want to draw it on a monthly chart, and you want to draw it at the top of the price bar, reaching an all-time high that is not surpassed for at least 3 months. That's 3 bars. Why 3 months? I did not do a lot of testing to see what would work at 2 months, 3 months, 4 months, 5 months. I chose 3 months because it seemed to work. And in the 70s, I used to get this chart book, that's CHRT, from Boston. And I would look at this, and it was a monthly chart book, and I noticed stocks that reached an all-time high, retraced for a while, and then whammo, went to a new all-time high. That's how it got in my head that breaking out to a new all-time high might be a phenomenal buy signal. Okay, so all right, so take a look at this chart for a minute. You saw my definition. Let me give you the definition again. At a top of price bar, reaching an all-time high that is not surpassed for at least 3 bars, okay, on a monthly chart. Where would you draw the green lines? Think about it for a minute. See if you really understand it. All right. First one, yes, right here. By the way, David created this. The second one, yes. No. Why didn't you draw a green line up here? Because it has this high peak hasn't been surpassed. You need it to rest for 3 months where the price bar doesn't go as high. You get it? You need to have, like here, you hit a peak, and now you have at least 3 bars where it didn't go through it. Now you draw your green line. Same thing here. That is a green line chart. That's how you draw it. Now, I said I prefer to buy stocks trading above the last green line top. You don't have to get it the day it broke through the green line. But if you miss it, wait for it to hit another base or a moving average. The O'Neill people use the 10-week moving average. I'm going to show you some other indicators. So, but you want it to be above the last green line. Okay, now, when I create these lines, and I'll talk to you about it in a minute, I put in TC2000, I right-click on the green line, and I set an alert. And that way, it'll tell me, that's for stocks that are below their green line, it'll tell me the moment the stock trades through the green line. Now, why is this a good thing? Because, look, if you have a stock that was 100 and is now at 50, you got all these people who bought near 100, 80, 90, 100, and they're holding something that's 50 because they didn't sell it. And basically they're saying, if this piece of crap ever gets back near 80, 90, 100 where I got it, I'm selling. That's overhead supply. That is selling pressure. But think about it. If a stock that fell from 100 to 50 can go through all that selling and break through 100, what an amazing buy signal. What an amazing sign of buying. So it's an absence of a overhead supply from sellers who had bought at higher prices who want to get out and get their money back. Okay? So just look at this. These are just some examples. Remember in the 90s, Cisco, look at this. People made millions on Cisco. Look, split adjusted, this stock is like under 5 cents here. Look, it went to about 70. Look at the green lines that I drew in. Look at all the places where you could have bought where it rested and then broke out. And then what happens? It formed a new green line top. You don't hang around. Can't you see the people who wrote it through here and are riding it here and saying, oh, it'll come back. And they're riding on it for 24 years. I don't think it's come back yet. Okay? That's Cisco. Look at Microsoft. Same thing. Look at the green line breakouts. Okay? Then look what happened with Microsoft. It hit a top at the internet top in 2000. And then it went 15. I don't remember when it broke through, but it was at least it was longer than this. You would have sat with dead money for 15 years. Don't do it. This is when you want to buy a stock, when it's in a rise heading towards the moon. All right? Apple, green line breakouts. Facebook, I'm going to mention Facebook, but I know that Vas, for those of you who've been with Vas for a long time, his techniques helped you to get in here somewhere. And I take my hat off to him. But for me, with an IPO, if it's long enough, I want an IPO that went way up, sellers came in, then it went sideways or down from, 5, 6, 7 months or a year, and then broke out through its green line breakout. This is an IPO base. And the only exception I make is sometimes there are stocks that only, go do this, but only for a few weeks, and then they go to a new high, and sometimes you can buy that. And I think O'Neill did that with Google. It didn't really wait long enough to have a huge base, okay? Now, I just want to give you another example. Look at ELF. You know how that's been on a tear? Look at this green line breakout here. I hope I've convinced you. Well, you won't believe me until you hear what O'Neill did. So I'll get to that. All right, here's NVIDIA. Look at all the green lines. Now, if you buy a green line breakout and the stock closes back below the green line, I get out. It's a failed green line. If it retakes the green line and closes up there, I buy it back. Okay? Because lots of times it'll have a green line breakout and then the stock will go sideways or come back to support at the green line. And if you use the stop, you'll get stopped out. So I just wait for it to close below the green line. All right? That's NVIDIA. Now, here's a William O'Neill quote from Richard Moglen, who was my prize student. I'll talk about him later. So the first thing I learned about how to get superior performance is not to buy stocks that are near their lows, but to buy stocks that are coming out of broad bases and beginning to make new highs. I only wish he had defined it, new all-time highs. I think that's what he looked at, and I'll show you why, okay? But again, it's stocks that basically went up, formed the base, and broke out to a new high, all right? O'Neill, in 2012, started in IBD a series of the best stocks. How to find, you see it here? How to find and own America's greatest opportunities. And he showed charts of the best stocks. These were stocks that he made a fortune in, okay? So I decided, by the way, this is what it looked like. So this is an example. Each page, he did this, I think, I don't remember if it was once a day or once a week. He would talk about it. This is Home Depot. And he would show where he bought it, okay? And look, by the way, do you notice that this is a stock hitting all-time highs from the get-go? All right? So I decided to take the charts that the stocks that he showed us and show where he bought and to draw in the green lines and look at what I found. Here's Skyline, all right? Came public, went up here. Formed the green line top here. Here's your breakout. O'Neill bought it here after the green line breakout. You, having taken this lecture, and once you know how to do green lines, you might be able to buy it earlier than O'Neill would have. Okay? Here's Home Depot. Kept going to all-time highs. O'Neill bought it in 81 and 82. That's in here and here. It kept going to all-time highs. There was really no big base here, okay? No green line. Here's Netflix. Here's the first green line breakout, okay? Went all the way up to here. What is that? 7-fold increase, okay? Came down, went sideways for a few years. Here's your new green line. Here's your breakout right in here. O'Neill began buying in 2009 after the green line breakout, okay? Here's Qualcomm. Oh boy, I remember Qualcomm. I actually went to a presentation by O'Neill in Washington, D.C., and he was talking about Qualcomm. He bought it in 98, 99. Notice it had a green line breakout. The stock went from 4 to 100 in a few months. Look at that. Okay. Here's Apple. Green line breakout here, then came way down. New green line breakout here. O'Neill bought it back here. Before, so he bought it on the space before, but he bought more after the green line breakout here. And then there was another green line breakout here, okay? Monster Beverage, green line breakout, O'Neill bought it in here after the green line breakout. Okay. O'Neill bought Google. There was no long base, so he bought it here. I think his associate said you should buy it because it was breaking out of a base. But notice, kept going up. He kept adding here and here. I didn't draw any green lines in there. All right. Chipotle, green line breakout here, came way down, came all the way back up. O'Neill bought some here, okay, before it had a green line breakout, but he bought again when it had a green line breakout right here. Okay, I can't tell what this is. Anyway, O'Neill bought here, all right after green line breakout. So, having looked at all of these, my conclusion is O'Neill bought many of these greatest stocks after GLP or an IPO-based breakout. He also bought some stocks before they had reached an all-time high, but were headed to all-time highs. He lived with stocks trading at all-time highs. So one way to pick winners is to buy at a green line breakout, or if you miss it, at support after a green line breakout, not buying stocks below the green line. I say don't waste time on basis far below the all-time high. Now, given what I've showed you, I'm amazed at how many people who talk about O'Neill and Can Slim and how he made so much money and how successful he was, and they're looking at cup and handle bases and double bottoms and whatever at stocks that are far below their all-time high. That is not the game that O'Neill was playing. All right. So I want to give you an example. The market bottomed in 2009. Here's the Qs. Here's 2009. Here's about April. You see the market started up. This is by the way, stage 4 in Stan Weinstein's stage analysis. This is stage 2. The only time you want to be in the market in stage 2. The GMI measures this. That's a 30-week moving average. Anyway, look. So the market bottom in 09. So what am I doing? I love bear markets because during bear markets, right, you don't have a lot of stocks hitting all-time highs. So you can see the winners. You got too many stocks hitting weekly 52-week highs and all-time highs in a big, strong market. But in a bear market, you can really see the winners. So here I am in 09. Running my scans on TC2000, which I've been using for about 20 years, 25 years. And it comes up with a stock that I knew nothing about. And I wrote about it in my blog. You can go back to my blog and find it in April 09, or you can search on GMCR. I wrote this post, this is the whole post, and what I said at the bottom is, there are a few other stocks breaking to all-time highs, including GMCR. I talked about QSII, which was breaking to a new high, but I saw GMCR and I plotted it, and, you know, I have to give you my honest opinion. I didn't buy it, but look what it did. Here's your green line breakout in 09, all right? At the beginning of when the market was breaking out, it broke out at less than 10 and went to 130. It had another green line breakout here and went to 130. Okay, it's GMCR. And by the way, and I talked with Judy about it, and she's much smarter than I. She went and she noticed that when she came by my office to give a presentation, because she used to give a lecture there too, like Lars does, she noticed that I had bought a Keurig coffee maker for my staff. And it turns out that the people who made that and who made the coffee was Green Mountain Coffee. So that's what was going on. It was showing up in offices around the country. That's why the stock took off. Anyway, but all I'm telling you is I found this before I knew anything about Keurig, just by the green line breakout. Okay. Now, how do you find a GLB using TC2000? Because it's no good if I tell you this and I don't tell you how to do it. So there's a built-in condition in TC2000 called price history new high. If you try and build a formula where you say, give me the highest high in, say, 1,000 days or whatever, any stock that didn't exist before 1,000 days out beyond 1,000 would get a null result, so you would lose the finding. This condition does it all for you, and it doesn't matter if it's a recent IPO or what. So you set the price history new high to monthly, and you set it to 1,000 buy high. I say it's 1,000 month high, and within the last 3 bars or last 3 months. Okay, so that's what that does. Now that gives me all stocks that hit an all-time high in the last 3 months. Then I put in this formula: high today. The high today is the highest it's been in the last 50 days. So that should give me, in a sense, any stock that hit an all-time high today. And then I say the volume is greater than 10,000 because I don't want junk. I don't like cheap stocks, so I say close greater than $15. I say the average 20-day volume is greater than 20,000. These, you can set these to anything you want. And then I say I want the stock today be closing up, or this statistic, which is a Stoke 1.1, is greater than 50. You'll understand this in a minute. What that says is that the price bar for today, the stock closed at least in the top half of the price bar. Okay, either one of those. So that gives me all the stocks today that hit an all-time high. So I have not found any way to automatically draw in the green line. So I take this list of stocks. I might do this at night, or oftentimes I do it on the weekend. And then I go to each stock's monthly chart and I draw in the horizontal green lines. Any stock that, anyway, so I do that. And then I set an alert if I have to for a GLB. But all of these stocks by definition had a GLB because they're hitting an all-time high. So that's how I do it. So you can now draw in your own green lines. You can find stocks that hit a green line during the past week or during the past day. And you can start drawing in your green lines. Looking at the stock, by the way, I don't just buy based on technicals. I then go to MarketSmith. I look up the fundamentals. I look just quickly to see are funds buying it. What's it do? I look at their indicators, their comp index, their comp number and whatever. Because if I have a set of stocks hitting an all-time high, a green line breakout, I want to find the one that looks the best fundamentally. Perhaps I do what Judy does. She looks at the percentage of stocks that are short, because if you have a high short interest and a stock goes to an all-time high, all those people who shorted it at the last peak are frenzied to buy back the stock. They have to buy back the stock before they have a big loss. Okay? So, indicators. Why do I scan for indicators? Well, when Mark Minervini came to my class and he taught them how he approaches the market, I talked to him at the end and I say, do you use any indicators? And he said to me, no. He says, I've been doing this so long, I can look at a stock and I can see if it has my setup that I want. And so he looks at, on the weekend, hundreds or thousands of stocks. And if you go back and listen to what David Ryan says and what his son Sean says, there's a wonderful interview that Richard Moglen did of Sean Ryan, by the way. They spend the weekends looking at thousands of stocks. I don't want to do that. I don't think I have to do that. So what I do, I say, you can spend your weekend studying thousands of charts to find the few that have your setup, so you can use indicators to whittle down your list to a few worthy of your research and study. I have a life, I have a career outside of the market. I want to be able to find the stocks with the key setups or the green line breakouts quickly, okay? Nothing against them, but they are full-time traders, Mark Minervini and the Ryans, and those people and the people who enter the trading competitions, they want to look at 1,000 companies. I'm saying that you can use, or I use, these indicators to tell me what stocks to look at more carefully, okay? So, stochastics is an indicator. I like you to understand it. I do this for my students. The stochastic for an X period, okay, basically looks at, for the period, looks at the high and low price traded during that period. And if the stock is currently at the top, in other words, the highest price at that period, it gives it stochastic, gives it a value of 100. If it's the lowest, it's a 0. I'm going to show you this. This is what I do with my students. So this is a stock. These are the last 10 days, the high, low, and the close price. We're getting the 10-day stochastic, okay, for once. It's called 10-day once, okay? So here's the high, here's the low. So this is the high price. So that's 60. This is the lowest price. That's 50. Where is the stock now? At 58. So the range is 60 to 50, and it's currently at 8. Where is it in terms of the range? It's 8 out of the 10 points are 80. Okay, so the 10-1 stochastic here equals 80. All right, now the 10-1 stochastic I use, daily stochastic, and it's basically looking at where is the stock now versus its 10-day range. Okay, it's a very fast stochastic. Okay, now the 10-2 stochastic simply does the same thing. The 10-1, the last 2 days it does it once, and it does it the next day it does it. So it creates the 10-1 over 2 days it does it, and averages the two numbers. The 10-4 stochastic does the 10-1 over 4 days, right, and averages that. And then the 10-4-4 stochastic does the 10-4, all right, and then averages that over 4 times. So the 10-4-4 stochastic is like a signal line in the MACD. Okay, so on a stock, this is what a stochastic looks like. The 10-4 looks like this. It's red. And the 10-4-4, the signal line, which is the average of 4 of these 10-4 stochastics, obviously slower. All right, that's it. When the stochastic is below this line, which is the 20 line, this is the 80 line, this is the 20 line. When it's below there, it's considered oversold. Okay, notice the 10-4, the red crossing the blue. I'm going to talk about that as a setup. That's my green dot setup. Okay, so I want you to just think about this a minute. On every daily stock, you have the 10-4 stochastic and the 10-4-4 stochastic, all right, which is basically showing you the strength of the stock. Now, first of all, a good technical setup, this is what I teach the kids. And you should think about it because it's really important that you have a setup that meets these criteria. It indicates a precise buy or sell point. It indicates that the desired move is imminent. You don't want to have a setup that says, it's going to move sometime. You want it to say, it's going to move if I buy it now. It provides a clear way to determine failure. In other words, you know when the setup failed. So it enables you to set a stop loss that minimizes your loss. And it has to fit one's personality and tolerance of risk. I know what I like. And Vas has his own way that fits him. And everyone will perhaps have a different way. So you got to try these out and see what works best for you. All right. So I have 3 dot setups that I'm going to talk about. They're all daily setups. The green dot I just showed you. The 10-4 stochastic, daily stochastic, crosses above the 10-4-4, the signal line. That shows up as a green dot on my chart. Except, and I'm not going to go into this much, I also filter that if the cross occurs very high in the stochastic, like where the stochastic is above 60 or 70, I ignore it. I want a relatively low stochastic where this cross is occurring. Next, I have the black dot stochastic, and the black dot stochastic looks for the 10-1. Remember I showed you the 10-1, which is a very, very fast stochastic? Today or yesterday was below 25. Or, so it's very low, very oversold, or the stock's current price today, the low, was less than or equal to the lower Bollinger Bands, and the stock closed up. So basically, this is looking for a very oversold stock based on either the the 10-1 stochastic or the Bollinger Band. I follow the 15-2 Bollinger Band, which means it's averaging 15 days of closing, and the Bollinger Bands or the confidence interval is written 2 standard deviations above or below, all right, the average. Okay, you don't have to understand all this to be able to, but what I'm telling you is I have designed numbers, parameters for these stochastics. That is not what everyone is using. And why do I use them? Because they're better. Okay. Finally, and this blue dot I got after analyzing Vass's charts. The blue dot is the 10-4 stochastic rises above 20. So it was very oversold and is now rising above 20. That's the blue dot. And I'm going to show you them. Now, I got to tell you the bad news. MarketSmith only displays the 14.3.3 stochastics. I learned this by contacting Scott St. Clair, one of their analysts, and that's what he told me. I know people have asked him to do others. They keep telling me they're going to make their statistics more variable so you can change them, but it hasn't been done. So I went recently and I looked through some gurus' explanation of stochastics. None of them use the settings that I use. Why do I use these? Because they work better for me. They all use defaults of some kind. And if they work, fine. But I'm telling you that these work better. I'm going to show you. All right. So green dot. Here's a chart. Here's the stochastic, the fast stochastic, the 10-4 crossing the 10-4-4. The red crosses the blue. Notice the green dots. Okay. And I have some people I know who trade. They want to see a green dot. It confirms a buy signal for them. Okay. Now, here's the green dots with the bounce. You see bounce off of the Bollinger Band. Here's the higher Bollinger Band, the low. I like to see lots of times a bounce off the lower Bollinger Band. A Bollinger Band, by definition, means, the way it's constructed, that over 90% of the prices will be within them. So when it goes outside them or below them, that oftentimes is a sign of oversold. So when I get a green dot or any of my dots and it's also bouncing off the lower Bollinger, that's a good sign. Okay, so here's the Bollinger Band bounce and a green dot. Now, do you know how science, if you follow science, you look at what everyone else has done, and then you add to it, and you have hypotheses and you check it. And I think I read somewhere, well, I did read somewhere, that both the helix, the DNA helix, came about by the person, Watson and Crick, one of them, sleeping one night and dreaming of the atoms holding hands in a helix. That's how he found it. And the people who figured out, these pieces of paper, I forgot the names, that you can stick onto things and they come off. That adhesive was a mistake. So this is my mistake. I have this program on my phone called Stocks Tracker, real time it's called. I love it because when I want to know what my stocks are doing, I can find it real time. I can find how it's going to open the next day, after market, the whole thing. All right. Anyway, I use it. And I have these charts that I look at during the day. Now, you don't have to be a genius, because I'm not one, to see, if you look at this stock and look at this is a stochastic. Note how when this is low like this, it hits the bottoms. This is when the stock bounces. All right, so you look at that. Look at this one, another stock, FTNT. Notice how when this is low, the stock bounces. Now it's not perfect, but here's a bounce, and here it's holding the Bollinger Band right here. If it bounces here and it fails, you get out with a minimal loss. Anyway, here again. So I'm embarrassed to tell you that I was using this, going to my TC2000, looking at the 10-4, and I never realized that I wasn't looking at the 10-4. I was looking at the 10-1 stochastic. See right here? I never noticed that. Here's another stock, Crocs. Look at the 10-1 stochastic. By the way, no one uses this. Okay, look at how perfect this is. Look at the bounces off the Bollinger Band and the 10-1 stochastic. So what did I do? I added to my charts the 10-1 stochastic. You see that? And it's gray. So now you have the 10-4, the 10-4-4, and the 10-1, which moves very fast. Okay? So I created a black dot indicator, which basically looks for the bounce, a stock going up after the 10-1. The gray one was below, it was 25. So here's an example of a black oversold. It goes up. Here's your black dot. Okay? Here's another. This is Goldman Sachs. Look at the black dot. Now, look. It didn't hold. The stock went up after having been below the 25. So if you bought it, you're out here with almost no loss. Here's black dot again, black dot again, black dot again. I'm telling you, this is kind of amazing to me because no one's using this except I am. My students maybe. Okay. So then I created this blue dot setup, which is the daily 10-4 stochastic crosses above the 20. Think about it as a stretched rubber band. Some people use like a basketball analogy, metaphor, the basketball held over water, below water, and then you let it go and it jumps up. Think of a stock being pulled down and being sold and oversold. And it's like got a rubber band attached from where it was to where it is now. And that rubber band is really stretched. And then the stock starts to turn up. Wham! Isn't that the type of stock you want to be in? A stock that's really oversold and then starts to move up and show strength? So memorize this and go back to it. This is the pattern I'm looking for with the blue dot. You've got the 10-4 below 20 and then moves above 20. Whether or not it crosses the other thing doesn't matter for this. It's just that the red line went below 20 and moved up. Now, when this happens, you want the Stoke 10-1, the very fast stochastic, to stay above the red. This is what it looks like on a good setup. It's moving up like this. If the 10-1 starts, which moves very fast, starts to come down to the red and maybe cross it, you're out. It's a failed blue dot. Okay? This is what a successful blue dot setup looks like. All right? Now, look at it. These are real stocks. Look at AMD. Here's the blue dot. Here's the red line below 20 and then retaking it. So there's your blue dot. Okay? So maybe you buy it there and you put your stop there, or you could put a stop down here. Okay? Look at the gray line staying above the red line, going all the way up here. That's a great setup, successful blue dot. Notice that after it had before it had the blue dot, it had black dots, and it also had a green dot afterwards when it crossed. Now, you are going to have to put these on your chart and look over stocks that you've traded and learn how to read these signals so you feel comfortable about it. By the way, here's a green line breakout here. All right. Next, NVIDIA. Black dot, blue dot right here. See? That the gray line, it came down a little but didn't cross the red and then resumed up. Okay? Here's another black dot and then a green dot. Look at that. Now, the reason it's not a blue dot is the red never got below 20. But the fast one, the 10-1, did. See? That's why it has a black dot. All right? These setups work phenomenally on the indexes. So look at the bottom. Look at when they had a blue dot here. Whenever the DIA or the Qs or the SPY go below, when this stochastic 10-4 goes below 20, look for a bounce. Here's a bounce here. Here's another bounce here at the bottom. Look at that. All right, it's blue because the red got below 20 and then retook it. Notice it got below the Bollinger Band and retook it inside, which is a good sign. All right, gold. Just look at this chart over here. Whenever gold got below here, boom, bounce, 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 bounce. Now, I have a confession. I watched these three, so I said, okay, here's the blue dot. I'll buy it right in here. And then look what happened. The gray line went up and then came back down. I sold. Okay, now it turns out gold did continue up afterwards, but I'm just telling you, it doesn't always work out. But it's a really good setup because if it doesn't look like this with the gray line climbing, it means that the setup failed. All right, now VAS's stocks and the dots. So VAS, this pullback signal is compared with our green dot and lower daily 15-2 Bollinger Band bounce setups. And I asked VAS to come on and explain these next couple of slides. You there, VAS?
Yes, I am. Yes, I am. So basically, this setup is actually not from me. It's a gentleman named Al Brooks. So if you look on Amazon for Al Brooks, you'll see a whole pile of books that he's written. So I kind of took his style and modified it to stocks, end-of-day stocks. So this is particularly one of his setups. It's basically a combination of trend lines and something called trend channel lines, which are the opposites on the opposite side of a trend line. So in this particular case, we're looking at a smaller trend channel line intersecting a longer uptrend. So when you get that intersection of the two, this becomes your low risk entry point, just like you said, that setup point where you can minimize your risk and potentially maximize your reward, because this is where you'd be entering. Your stop would be under here and your reward would be above here. So always looking for that sweet spot that's at which you can enter. Keep going. So this is what it looks like. So this, we call this a combo. Actually, this line is wrong. This line should be under here. Basically, it's a combination of a trend line and a trend channel line intersecting together. So keep going. And sometimes you don't have that
Oh,
combination.
that's it. That's
Oh,
it.
that's it. Okay.
Thanks, VAS.
Sure.
The key thing is note that the stock is in an uptrend. So when I'm showing you these setups, if you apply these setups when the stock is in a downtrend, really, they generally don't work unless, like it did with the Dow and the SPY, when the thing is ending. But usually you want to do this when a stock is in an uptrend. Okay, so here's an example right here of where it met VAS's criteria for a bounce. All right, so I then looked at this with the dots. So I'm looking at the same thing. This is October. This is my chart. In October, you have a blue dot right there, a black dot and a blue dot at the same place. Now, I want to tell you, he uses arithmetic charts. I use logarithmic charts. I don't think it would change any of this, but I just want you to know. But also notice in this stock, blue dot bounce, blue dot bounce, blue dot bounce. All right. Next stock was end phase right here in May. Here's his signal in May. Here's the signal in May. Blue dot right here, the same place. I put the arrow where it is. And notice it's also bouncing the lower Bollinger Band there. Okay, next one. United Healthcare right here in October. Here it is in October. Here's the signal. Here's the blue dot with a black dot. You can see that, you can see the stochastic that way. Okay. This is CVX in July. These were all stocks that my students had traded in their portfolio. So that's why he said he would analyze them. Here is the bounce where he said in July, here's a black dot and a blue dot. By the way, note there's another blue dot here which would have been tradable. Okay. SMCI in July, right here. Here it is in July. Look at this blue dot. Okay, notice the black dot here. All right, black dots here, black dots here. These are blue dots. This one failed. Notice the failure here. The gray line came back down below the red. You're out. All right. All right. So my conclusion, I was amazed, Vas, when I saw how the correspondence between this. So it's not to take anything away from what Vas does. All right. Here's my conclusion. Vas's rebound signals often occurred at a bar with a blue dot, some of which also had a bounce up off of the lower daily 15.2 Bollinger Band. So the implication is find possible Vas type setups by scanning for blue dots or a daily 15.2 Bollinger Band bounce, and then looking at your trend channel lines, okay, for a confirmation of what Vas's technique says. And by the way, Vas agreed with this. He was I think his response was, wow. So you can combine what I'm showing the indicators today with what Vas is doing, okay? Now, my homework assignment for you is to plot the daily 10-4 and 10-1 stochastics at the bottom of every daily chart and test this hypothesis. Every significant rise occurs after an oversold 10-4 daily stochastic under 20 or a 10-1 daily stochastic under 25, but not every oversold stochastic leads to a rise. In other words, it's necessary but not sufficient. And basically, I don't think anyone in all the technical analysis I read ever said anything like this. But if you go back and look at stocks over time and look at their rises, I think you will find this is largely true, that a stock starts from a significant rise starts from an oversold condition, defined this way. Now, I'm going to show you some more examples. Here's a blue dot at the end. Remember the SPY bottom in November? Notice, again, if you wanted to day trade or something, you could buy here and sell around here near the top Bollinger Band. You buy here, sell here. Here's the real bottom, right here. So whenever you think the market's been falling and you think that it's going to go a lot further and everyone is talking bearish and everything, see if it looks like this. If it's a blue dot, maybe it's time to buy some. Okay? I'm going to show you some other examples recently. American Express. Look at the pattern here. Perfect. Blue dot. Look at the gray line above the red. All right? I actually traded this. Okay? I traded it largely because it came up with a blue dot. All right? Look at PANW. Blue dot here. I traded it. AMAT. These are all stocks I traded, by the way. This has rarely happened in my life, but I haven't done this very often. And as I told you, I'm now near retirement, so I'm very conservative. Most of my trading IRA is in the ETF T-bill, which pays about 5.2%. It invests in 1 to 3 month treasury bills. There are a number of ETFs that do this, but I like to collect 5% of my money, for now, while the rates are high. So look at this. When this blue dot occurred, notice the red line crossing above 20, okay? When it occurred, I decided to buy a call option, all right? Now, since these setups occur quickly, I don't want to go out more, 20, 30 days. I'm not betting on a large move. So I bought the 10-day 144. I think the stock was about 142 or so. Anyway, no, 152 or so. And I bought the 144 for $10.11, which means the stock had to be a higher than that plus this, a 154.11 for me to make money. All right. I bought it here for $10.11. That's $1,000 above the Bollinger Band, which I didn't like that it did it. I sold it for $20.37. So I sold the call option that I bought for roughly $1,000 for $2,000 in 3 days. And I plan to try more of these techniques using call options on blue dot purchases. Anyway, I probably shouldn't have bought it because I sold it because it had a green line breakout there, but it did go higher and then came down lower. So it turned out to be a good trade. I don't do a lot of those, but I just wanted to tell you that from my experience so far, in a strong market, blue dots work. I also did the same thing with Citibank. I noticed it came up on a scan that the blue dot noticed the gray line here. So it was a really nice, successful, turned out to be successful. And look, I bought it here, and look, it got out today outside the Bollinger and closed below it. You can see this is where it's trading after market at about 56. So that was like, what, a 10 to 12% gain in 5 or 6 or 7 days. So I'm really excited about this. I've never had a setup that works like this one does. And by the way, notice it had a black dot and a green dot. Okay. Now, the nice thing about it is if I bought it, and I bought shares, I didn't buy a call option on it. If the gray line had come back down, I just would have sold with a small loss. And I don't have time to go into this in big depth, but I want to just run this by you. I do tell students about this at some point. Jesse Livermore, I can't find the real quote. He once was interviewed, and basically he said his answer was, I'm not interested in percentage gain. I'm interested in points, number of points it moves. Now think about that. If you can buy a gazillion number of shares, you don't care about percent move. You want that to go up many points. Well, think about it. If you're buying a call option on a stock, all right, which generally a regular call option, it's 100 shares. Instead of buying it on a 10 or 20 or $30 stock, which may move, if it moves 10%, it maybe moves 2 points or 3 points. Buy it on a triple digit stock, like $100 stock or $200 stock. Because if you're right, you're going to make 10, 15, 20 points. This works. Okay. Just think about it. If you go to TC 2000 and you put in a column C minus C20, that's the close today minus the close 20 days ago. And then you sort all the stocks that move the most number of points are the triple digit stocks. Just check it out yourself. Anyway. All right. So, I wanted to give you a demonstration. I guess I have time. I took out superfluous charts. I hope I didn't talk too fast for you, but I want to, in my blog, I oftentimes do this analysis, and I've been doing it for years, and it works. So I'm going to just show you this quickly. This is something I posted on November 2016. Okay. So this is the change in the indexes from 11/10/16, from November 10th, 2016 to January 13th, 2017. And I used to do this analysis just for fun. So look, during that period, the SPY went up 4.7% and the Dow went up 5.6%. And during that period, the triple Qs went up 6.4%, so a little more. But the TQQQ, which is the triple leverage QQQ, went up 20%, basically, more than 3 times what the Qs did. All right. So then I said, let's look at all of the stocks in the NASDAQ 100. How many beat what TQQQ did, which is 20%, 22%? It was 12% of the stocks. Dow 30 was 10, and the S&P 500 was 13. So roughly 80 to 90% of individual stocks were beaten if you just bought TQQQ and held it during that uptrend. Now, the interesting thing, the reason I wanted to show you this one from a long time ago is notice that in 2016, which NASDAQ and S&P 500 stock did the best? It was NVIDIA. That should tell us something. NVIDIA, during this period, 8 years ago, showed up even then as the stock that did the best. Maybe in order to find leaders, you want to find stocks that are already leading. In fact, Nicholas Davis and David Ryan both have said that they like to find a stock that has already doubled in the past year. It's like human behavior. The best predictor of future behavior is past behavior. You want to find a stock that's going to double, find a stock that's already doubled. So when I find a list of stocks hitting a green line breakout or looking good, even having, one of my setups, I always have a column that shows me the close today divided by the close 250 days ago to see, is it a stock that's already doubled? Because that's one more reason that I like to hold it. Okay. Now, the Qs. Wait a minute. I got to do something here so that I have this lined up. Let me see. I'll be with you in a second. I guess my TC2000 closed while I wasn't looking at it. Okay, so I know I'm not sharing it yet. So here is the Qs since the bottom, basically the new rise that started on November 1st. You see what the Qs did? They went, here's the blue dot, and the Qs went like gangbusters, okay, in a nice uptrend, okay? So it was November 1st. So now, and I got to do a new share, which, let's see. I hope you can see. Can you tell me, can someone tell me whether they saw it, Vas or Mike? Can you see this?
Yes.
All right, terrific. So if you look at TC2000 here and you say, okay, from November 1st to current time, how well did QQQ do? So if I go now to tools to custom date sort, okay, and I go from basically November 1st to current time. Let me see, do I have it? One more, okay. During that time, by the way, the Qs went up 17.3%, okay. Now I'm going to sort, and I'm going to add the column here to my watch list here, okay. And what I'm going to show you, I don't remember the number. What was the number that I said the Qs were up? I can do this. Forget it. I got it. Let me add the Qs here. So the Qs were up 16.8% during this period. Okay, this is showing me for every stock in the watch list, it shows me how much they changed over that period. So it's say 16.8%. So now let's look at among the NASDAQ 100 stocks, how many stocks are up more than 16.8%? We got to sort by it. It's going to make a liar out of me. Let me see. Half the stocks are up more than, I've never seen this before, are up more than 16.84%. So TQQQ here didn't beat everyone. I don't know why. Let me see by the SPY what happens. The SPY. Up 40%, 221. So I don't know why this is happening. I'll have to look into it further. But most of the time when I do this, the
Dr. Wish, can you
yeah,
hear me?
did I do something wrong?
Yeah, you're supposed to compare TQQQ, not QQQ.
What was TQQQ? Let me go. Let's see. All right, sorry. All right, let's do it again. TQQQ was up 53%, 52.71, 53%. Okay, thank you. So if you now go to NASDAQ 100 and say, how many stocks were up better than 53%? 3 stocks. All right. Therefore, the TQQ beat 97% of the stocks in the NASDAQ 100. Okay. If I look at the S&P 500, what do I got? Under 1%. Under 1%. So here's what I'm telling you that you might want to consider. If you think that the Qs are in an uptrend and you get in at a reasonably good time, if you can accumulate TQQQ over time, not all at once, you will beat 95% of all other stocks. Meaning, if you want to go and find the needle in a haystack, go ahead. But if you just want to own TQQQ, you're going to beat almost all stocks. Let me show you one other group, by the way. If I go, let me just look at this a minute. Just want to get the right number. 53%. Now, if I go to flagged stocks, which are stocks that have been in MarketSmith or IBD in the recent past, not too recent, because it wouldn't be fair to do that. Because it would, all right. And I would look at how many of them beat TQQQ. I have 1,100 stocks in this watch list of all flag symbols, 53 stocks. What's that, 5%? 57 stocks. So it even beats most of the stocks that have shown up in the IBD 100 and in the MarketSmith Growth 250, which is what this contains. Okay. So again, I want to make the point that you can do really well by owning TQQQ. I do that sometimes. All right. I'm going to finish up. Richard Moglen was my student. He was an engineering major. He took the honors program course that I teach when I first taught. He was building his own indicators. He got accepted to engineering school, the master's program, decided instead that he had got the passion for the stock market. He started doing interviews on YouTube with traders. He's interviewed all the greats, okay? And he also did a number of YouTube videos of my setups that he learned in the class. You can go here to find him. He is now a co-owner, I think, of Trader Lion, and he's in charge of he's director of education there. I urge you to listen to him. He does phenomenal interviews. You can just Google his name and find it. He also has a great Twitter site. All right, that's his Twitter handle. You can also, these are other people that I like to follow on Twitter. Other than Richard, there's of course Voss's site is right here. Liz Ann Saunders.
You're showing the TC 2000 right now.
Oh my God. So let me stop sharing for a minute. I'm going to do a new share. Thank you for telling me. All right, can you see it? Miles?
Yes.
All right. So you might want to check in with Richard. He's great. Has interviewed everyone, Mark Minervini, the Ryans, just all the people. He now interviews people who win the trading championships. You'll love it. All right. Richard Moglen, TML Trader, which is Voss. Liz Ann Saunders, I know she works for Schwab. She's on TV a lot. She puts out a lot of economic statistics that I think are great. Monster Stocks 1 is John Boyk, who is tremendous. And puts out a lot of screenshots from investors.com. David Ryan doesn't tweet much, but boy, when he tweets, you got to listen to him. Mark Minervini, also great stuff. Sorry, I have, I'm sorry. This is TCL Trader. This is Voss. TML Trader is someone I met at Mark Minervini's. His name is Erman. He's got he's part of Ticker Monkey. He has a portfolio service that he does. I love his work, and he oftentimes tweets out stocks that he is buying in his portfolio. I told you Vas is TCL trader, and then this is yours truly. I try and every time I do post, I try and post every night after the market closes. And the link goes out on X, and occasionally I will tweet out when there's a GLB, but please know that if I tweet out intraday, it's for you to research. It doesn't mean I buy it. It's just a GLB, a possible GLB. I may even do it with some of the blue dots, but it means you've got to look at it. So you got to set this up on your own system. All right. Again, my Wishing Wealth blog, my X thing. You can send me an email at ewish@wishingwealthblog.com. I can't answer a lot. You can even on X, if you send me a direct message, I sometimes see it and can answer that. I've thoroughly enjoyed talking with you. I hope, looks like we still have more than 90% of the people who started. So maybe I didn't, put too many people asleep. I really enjoyed doing this. If you don't have TC2000, you can go onto my blog. There's a coupon here for initial use that you can get. You can also see some of my scans here. And if you Google Dr. Wish's green dots or black dots setups, you can go to a YouTube site that my late co-instructor David McCandless set up for the students, which tells you how to put these dots onto TC2000. And it also shows some more things about guppy charts and green line breakouts. It's old, hasn't been updated, but I think you'll learn from it. I think that was all I had.
Yeah, Eric, I think one of the big questions people were asking about was the blue dot setup.
Yeah.
Is it possible for you to show the TC2000 version?
Let me see. I'll probably mess it up. Let me see. It might be easier at this point for me to include it in some material that I'll make available. Let me see if I can get on TC2000 again. It's gone again, I think. Let me see. No, it isn't. It's here. Now how do I got to do new share, I guess.
Yeah, you need to do a new share. Stop share.
I think this is it. Tell me if you can see it.
We can.
You can? So I want to figure out how to do it because this is not, I know what to do. This is not the blue dot. I have to go into another setup here. Let's see over here. Okay, the way I do it is,
Dr. Wish, can you just click on the label up on the label line, and that should show you the PCF, no? Right
no,
on
no,
the-
no, I know how to do it. Don't worry.
Okay,
I just got to go to edit where it says edit. Where is the edit thing? Here. Okay. This shows you a huge number of stuff I have. And now I have something called Blue Dot Daily. Okay. And this is what it looks like. It's quite easy. So the 10-4 is greater than 20, and the 10-4 yesterday was less than 20. All right. Volume is greater than 20,000. It's true. Close is greater than 30. Close is greater than close yesterday, or the Stoke 1.1, which again is today's bar, is greater than 50. So in other words, it at least closed about on the top 50 bar. You get it? All right. So that's the setup for the blue dot, but I have some three things that I like to, sometimes I do it, but I like this one the 10-week average, this is 10, this is set to weekly. The 10-week average is greater than the 30, and it closed greater than or equal to the 10-week average. That's what this says. I want that to be true with the blue dot, so I know I've got a stock that's in an uptrend. Okay? And then sometimes, I don't always do all three, and sometimes I'll do the three, and then I will I'll turn one of them off or whatever. The third one is that the high today, it reached a 52-week high in the last 5 weeks. That's what this says. High equal maximum, high 52 in the last 5 weeks. I don't always do that. So when I do this, setting, I'm going to take off the 52-week, and I'm just going to show you these two things, okay? The blue dot and the 10 greater than 30. And when I do that, and I set it to all flag stocks, which are the Market Smith IBD, and I filter on it, I come up with one stock that did it, and that's Juniper. And see, that's like a problem with it. I haven't changed this. It's not doing anything, but see how the red line went above? And if I go to my combo list, which includes all US and foreign stocks, I come up with SIMO, and this stock had a blue dot. I don't like it because it's right up against the top Bollinger, but this is a blue dot. And if I go to, sometimes I'll do this with ETFs, see if anything comes up. 2 ETFs came up today. All right. So BlackRock Health Sciences has a blue dot. See it? And it had a black and a green. If I was interested, maybe I would look into it. Maybe I would buy it. The second one was the government credit bond. No, there's nothing there. So I like a stock that comes up on this, and then I sort it by price, and I like to get stocks that are triple digits, because then if it's going to bounce from oversold, it could really move. Okay, was that it?
That helped a lot. I appreciate it.
Yeah. So I can close TC2000, right? I'll put it down. So now I don't know what I'm sharing.
You're not sharing anything.
That's what I figured. So this is the okay. I don't know what else. I think that's, yeah, I did the demonstration. This was like TC2000 I did in 2021. QQQ advanced 6%, 60%, TQQ rose 244%. And look, only 3 NASDAQ 100 stocks beat TQQ, 5 S&P 500, and 18 of the watch list. So again and again, every time I do this, I find the same thing, that sometimes instead of trying to find the individual stock that's going to do well, if my QQQ short-term trend count turns positive and I start counting, so watch for that on my blog. If it turns to day 1, day 2 on it, I start buying TQQQ, just a small amount. And I always tell you that if it gets to day 5, I add more. And so if you get in early on TQQQ and you get a 30, 40, 50, sometimes you get an 80-day rise before it turns down, you can make a lot of money.
Dr. Wish,
Yeah.
do you buy one buy when the green line breakout happens, or do you pyramid?
Oh, it varies. Sometimes I pyramid, sometimes I don't. I don't have a rule on it. Remember, I'm very different than I was a few years ago. Now I'm just mainly trying to maintain my money and not get hurt by inflation. And I'm building these setups so I can teach other people. Mark Minervini says he has his VCP and he has one setup and he's an expert at it. I've never been that way. Over my 50 years, I've changed how I do things. And as you can see, I'm still improving it. I really like the blue dot setup, but I don't know if it's working so well just because the market was strong. And I'll leave it to you to try it and see how it does. And then let me know, let us all know if it's working for you. I think it's a great setup. But the beauty of it is, as with Voss's setups, you get out when it's wrong. You get out when you have exact idea of what failure looks like and you sell. You can always get in later again, but you want to get out when the setup fails.
Dr. Wish, have you back tested TQQQ green when GMI is green and red, getting in and out over a long period of time?
No, I never did it that way. I'm usually buying TQQQ in an up market.
No, but when do you get out though? What's your out indicator?
Oh, it can vary. I don't have a specific thing. I look at a lot of things. I'm very careful about the market being in an uptrend, and I'll look very carefully at the 4-week average, the 10-week average, and the 30-week average. And I have this thing posted written on my computer. Before you sell, look at the weekly chart, the 4-week, 10-week, and 30-week, because lots of times the stock is holding the pattern beautifully, but just on a daily basis, you're having a bad day. And so I try and watch that. I know O'Neill used to say when it closed below the 10, he seriously would get out. I look at the 4, the 10, and the 30. I don't know let me see if I can do this, because how much time do we have, guys?
We can go for a bit.
Well, I wasn't going to show this, but I can do it. Let me share again. Let me see.
Because I tried back testing that specifically with your GMI red or green and red in and out,
Yeah.
and the results weren't that great, just, following it precisely. So I was kind of hoping you would give us some advice on getting out at the right time.
Here, look at this. If you watch my my blog, you know about the 1030 chart.
Yes, sir.
All right, here it is. 10-week for the markets to be in an uptrend. The market has to be in a stage 2. Your red line is going up. That's
Yes.
the 30-week average. The 10-week is above the 30, and most of the time you close. This is the closing price. This is the weekly chart, so this is the weekly closes in a sense.
Yes.
Should be above here. Whenever it gets like this, I get worried. Whenever the red line turns down, I'm out. That's what got me out in 2000, got me out in 2008. I've done, you know what? If you want to see more about this and timing the market, go to the Trader Lion 2022 conference that I did.
Yes.
And I went deeply into this. But I got a little bamboozled here in my blog, and I said people I was getting out, and I was wrong. And if I had known the blue dot thing, I wouldn't have sold so much here. Okay. But as soon as it came back, you're back to the races. And right now, we're still 10 is above the 30, and you're closing above the 10. Now, I want to show you Qs. The Qs the same way. By the way, these are during my class. As they learn, I have them do a sentiment survey. A sentiment survey in class every time they come into class of what they think the QQQ is going to do over the near term. And I just want you to notice the class was at 18% bullish right at the bottom. I was teaching them a contrarian indicator, and this was phenomenal. But anyway, here's the Qs, and above, this is the green line on the Qs because it had a recent green line breakout, and we're still very much above the 10 and the 30. Okay. Now, for looking at individual stocks, though, one of the things I look at is this, and that is in a rise. This is Tesla. In a rise, you should be, the 4 should be above the 10, it should be above the 30, and you should be closing above the 4. When you close below the 4, that's a warning sign. When the 4 closes below the 10, that's a sign to get out, especially if it closes by the 30. I could show you some other, let me show you some other stocks to show you this. Look at what happens. This is what a rise looks like. 4 above the 10, above the 30, and you're basically holding the 4. You're holding the 4, okay? When a stock has been holding the 4 and then closes below it, I might take some money off. When it comes back above, you see the green bars? This is a green bar, weekly green bar. It means the stock is retaking
sir.
the 4, retaking the 4. Let me see. What's another great stock? Nvidia. And, you know, stock on the rise. The 4 is above the 10 is above the 30, like that. And one of the things that actually Judy, my stock buddy, taught me is whenever a stock starts floating above the 4 like this, it's usually extended. It's going to come back. All right. Oftentimes, Nvidia has been extended all this time, but oftentimes when you see this like this, it's the end of a run, at least for a little bit. You know.
Thank you.
Yeah.
Dr. Wish,
Yeah.
going short, when the 30-week turns down, would you go into SQQ?
No. Well, I use more a shorter term thing for that, but I don't do a lot of shorts and everything. But I would only use SQQ and TQQQ based on the daily pattern, I think. It's up to you. But I think, for instance, I wrote a blog post, remember, on Tesla? I said, look how horrible it was. It was below the 30-week. The 30-week was curving down, and this is when the earnings came out. And I wrote the blog post in here. And now, you know, do you want to short it? Well, it had a blue dot today. So I'd wait for this to fail to short. And when you want to short Tesla, you know that there are bear ETFs like this TSLL, which will go up when Tesla falls. Oh, that's the bull. I'm sorry. This is a bear one, or there's a short bear. All right, this one goes up as Tesla falls. TSLS. You see? And there's also one that's a 2-time and a 1.5 time. Leveraged.
But you do those on the daily rather than the weekly for the short.
Yeah.
But what about the indexes themselves when you perceive you're going to have a king size problem and the 30-week is heading down?
Well, it's great to find something in a stage 4 with the 30-week coming down, but then wait for a bounce back off of the declining moving average, like the 10-week, or the one of the other ones that people use. The other thing you can look at is a bounce, you know, when the stock is in a downtrend, a bounce off of the upper Bollinger Band. I used to have, yeah, used to have.
Dr. Wish, quick question.
By the way,
for you.
hold on. This is the guppy chart, which I love because this helps you also. This is, you want the red, white, and blue pattern, the red above the white, above the blue. These are the short-term averages above the longer-term averages with this. So I would suggest you look at this too when you're shorting. So Tesla is, you know, it's amazing to me that people will hold on to these stocks when it goes from a red, white, and blue to a blue, white, and red like this. Look at that. Look at SEMI, which I talked about is great. Look at this. Red, white, and blue for months. So there are a lot of ways of doing this. I just wanted to go over a few of them. The dots, but there are many ways that I teach in my class. I teach the students to use any of these types of approaches if they want.
Dr. Wish, with TC2000, is there a minimum subscription tier to be able to do what you're doing?
I don't know too much about it. You should go to tc2000.com, but the price that you pay There are all sorts of different things. Like one of them is delayed. One of them doesn't allow you to do alerts, or more alerts. There's also, you can go to their site and look it up.
Hey, Dr. Wish, wanted to ask a quick question with regards to, when you say when it closes, when a stock closes below the GLB, closes.
Below the green line.
That's when you get out. Is there a specific point, like a 3% below or a
No.
dollar value below?
No, as far as I'm concerned, it should never close below the green line.
Okay, thank you.
Yeah.
Dr. Wish,
Yeah.
hi, this is Aniket from London. I just wanted to ask about your market indicators. So once the GMI turns back to green, how do you normally scale in your positions? Is it stock by stock? This might be an amateur question, I'm sorry, but how
No,
would
it's
you
a great
scale in your
question,
positions?
and I don't have a really good answer to that. I can't give you a recipe,
Okay, yeah, no, of course.
But my goal is if the market trend changes, you get in stages. So you think there's a bottom. Just remember, when you think that there's a bottom, that's the scariest time because the market's been going down, right? So it's hardest to go plow in there. So basically, you make a small buy, and then if it's right, if the bottom holds, then you can add more and more going up. And then where you put your stop depends upon how much you want to risk.
Okay, brilliant. Thank you so much.
Yeah.
Hello, Dr. Wish.
Yeah.
Hey, I just wanted to thank you very much for this. I've been following your blog. I'm going to purchase the scanner. It seems like it can do so much, and I just appreciate the real information. I see so much stuff on YouTube, and I know these gurus don't even know what they're doing. So thanks again for helping us out here in this community.
Well, as I say to my students, you're much more important than I am, because without me, there's no class. Without them, there's no class. Without you, I'm talking to no one. So I really appreciate it.
No, it's wonderful, and I know everyone wants a magic pill, but I think I can take what you did, watch it again, and start learning how to use the scanner, because my scanner will not do this. It just seems like a great tool, and I've already been successful in covered calls, so now I'm going to start looking more into TQQQ. I've already made a little money from your blog, so thanks again.
Thank you, and thank you, John. I appreciate it.
All right, have a good day. Bye.
Yep, you too.
Dr. Wish, this is Tracy. I appreciated everything you've done. I actually took your class several years ago. I was the guy with my arm in a sling at that time.
I remember.
A question. You mentioned you were a psychologist background.
Yeah.
Could you comment on how that's influenced your trading? And also, I learned recently of another psychologist, Van Tharp, who's written books.
Oh, yeah.
Any comments on either him or your background, how psychology influenced you?
Well, a lot of people talk about Van Tharp's book. I haven't read them. I actually think the thing that helped me the most is I'm a research psychologist, and I study patterns and I study databases. And that made me feel very comfortable using TC2000 and, and trying out different variables and different parameters. That's what I do, in terms of my career. So I think that's it. But you have to, in terms of the psychology, I've done a lot of human potential work that was better in terms of than my classwork. And I did, groups and everything. And I think you got to get a hold of yourself, because you got to know what you want and how you react to things. And there's a book by Adam Smith written in the 70s. It was George Goodman writing under the pseudonym Adam Smith, called The Money Game. And he talks about, it's really a good, interesting, fun read. And he talks about how people get what they want out of the market. So there are people who want to lose, and that's what they get. There are people who want to be victims, and that's what they get. I think that Mark Minervini has a book that came out that I reviewed, actually, and it talks all about the psychology of the psychology that it takes to be a good trader. And I think that I agreed with a lot of what he wrote. It's a lot of the things that I learned over my lifetime. I think one of the things that I can tell, that I tell the students that I think is important is you have to learn to take losses and to the next game. So you can't, and Minervini does a phenomenal job mathematically showing you how you can make money if you take a lot of small gains and compound them, as long as you're taking very small losses. And so when the students trade in the competition that I have them do in class, I require that they not lose. They're managing $100,000 and they can only buy $20,000 max of any stock, and they can't lose more than $500. So when I say to them, it doesn't matter if they made money or whatever, if they can control their losses in this type of thing, they have a chance of succeeding. So, I mean, it's a great question, and it's very hard for me to figure out what it is about me that has helped me over the time. I guess I don't beat myself up when I have losses, and I've had losses. I remember I went to Baltimore a few years ago and I was trading Taser. And remember, Taser was a phenomenal stock that went up sevenfold. And I was going to a meeting in Baltimore, and I had a nice game. And I said, I don't have to put a stop in. When I came out of that meeting, I had lost $28,000. So I learned not to go to meetings in Baltimore. No, I learned to set stops religiously. And even then, I didn't do it all the time. But now, if I buy something, the first thing I do after the purchase is put in my stop. The turtles, the book, The Complete Turtle Trader, is a great book about the turtles. And one of the things, they were very successful traders, commodity traders. And one of the things they were taught to do was to enter every trade with the possibility or likelihood that they could lose. So they had to know right up front what they would do if it turned, what they were going to do if the trade went against them. So I've learned a lot from reading these books, and I remember when I read How to Make Money in Stocks many years ago, and William O'Neill showed a portfolio that he was trading, and I saw a lot of losses. And when I read that, I said, gee, that taught me that it was okay for me to have losses. So it's sort of a lot of different things that I read from the successful people helped to educate me how to behave. It's really important to do that. And all the books that I have people read in my class are books by people who've walked the talk. That's very important, because you have loads of people telling you, advice and giving you advice, and they never basically made any money, other than selling their books. In fact, the great Forbes, I think it was Steve Forbes of the Forbes family, once said that his relative, his father or grandfather, once said, it's much easier to make money by selling advice than to be in the market.
Dr. Wish, do you have I see all the formulas for your GMI indicator. Do you have the formulas or how you calculate the QQQ uptrend, downtrend? I think
No.
that's different, yes?
No. If I do that, you'll never come to my site. I gave you some hints.
I hope you pass it on to someone, though, at some point.
What?
I hope they get passed on to some member of your family at some
Oh
point.
yeah,
because it's
I've got
secret.
some close people who know it.
Brilliant.
Yeah.
Dr. Wish,
Yeah.
is there any chance you could convince the university to add Zoom to your 14-week class so people from out of state could join your class?
Thank
That's
you.
a great.
Is that George?
Yes.
Yeah, thank you, George. First of all, my class was on Zoom during the pandemic for my students, and I could not let other people in on it. And I can't let other people come to my class. And the business school thinks what I teach is voodoo, although that doesn't affect anything. But I have toyed with the idea of offering the course someday either through the university or through another vehicle, because I get a lot of questions from people asking me, if they could take the course. I'll tell you a little story. In the 90s, when I was making a lot more money in the market than I did at the university, I started writing a book and keeping a diary. And the title of the book was a trading manual for my sons. I have 2 sons now who are in their mid-30s, and none of them are interested in learning from me. David Ryan is very fortunate that Sean is listening to him, although he's gone off in his own way, as he said in his recent interview. And so that book, I went back to it last year and started updating it because, things have changed. But I hope to publish it someday so that people can benefit from my journey, just like I did from the journey by Davis and other people. And again, I'm not a day trader, and I'm not a trader like a lot of the people who enter the contest. I'm basically can tell you how I did things being a part-time trader, and so I hope to finish that at some time. I'm on a special situation with the university where I only have to teach now my 1 course a year, and I taught, and I'll teach next fall. And then I finish with the university the following July. So I'm not sure what I'm going to do afterwards, but I love doing this. I love teaching, and I will try and still, connect with people.
Well, I hope one day you would at least do some presentations with Judy.
Yeah, we've been talking about it.
Well, I'm going to nag you to do something when you're retired.
Right.
Dr. Wish, I noticed that a lot of the trades that you're holding right now, that they're 5-6 months old. Do you see that this also works well with swing or position traders who hold positions from 2 weeks to 2 months?
I'm not sure how how long I hold positions.
Because you've got them on your website.
What do you mean?
The stocks that you list on your website has acquisition dates on each stock.
It does not.
It says opened or entered. It doesn't?
That is
Doesn't
the
it?
date. Hold on. That is the date that the green line breakout occurred, and it gives you the value of the green line.
Oh,
I don't own any of those stocks.
oh, okay.
All right. The point of that table is to help people understand that buying stocks that have a GLB can be profitable.
Gotcha.
I'm glad you asked, because I hope no one else has that. There may be other people who have that idea.
Yeah, might need to update your website. But
yeah, I can. What?
It says that's the date the green line occurred, Miles. It's not hard to read.
Very good.
But one would assume if that's the date, then that some action would have been taken.
Yeah, I will annotate that a little better.
Thank you.
Okay, thank you for the question. There are no bad questions. It's good, because especially in class, there's so many other people who have the same question, and many don't want to ask. They're afraid to ask. So it's great when you ask a question. So I appreciate Mo, and I appreciate the conversations we've been having.
Thank you for everything. You've been great.
Are you a student at the university?
Me, Mo?
Yeah. I didn't hear your answer.
Did you ask me, Mo?
Yeah.
No, I was never
Okay.
a student at the university.
You're not. Okay. By the way, students who took my course, some of them have gone on to start their own hedge fund. Like Richard, their lives have changed out of this, because you don't get this anywhere else. Nowhere else, and there's no other university that I know of that offers a course like this that'll teach you technical analysis, the CAN SLIM, the practical things of owning a portfolio.
And you also distill all of the wisdom from some of the market wizards, which nobody else does either.
Well, John Boyd does a good job of that, by the way. I'm telling you. You know, I can't manage as many different things as he does. He's looked at a lot of things. I have to get things down to a very simple, easy to understand approach.
Well, with that, I thank everyone for joining us. I especially thank you, Dr. Wish. As usual, fantastic presentation. And as I've posted in the chat, we'll have the videos up in the next few days.
Okay, thank you, Miles. I so
And-
appreciate your support and holding my hand through all the IT. And Vas, I can't thank you enough for all you've contributed to my students.
Oh, sure, Dr. Wish. And I want to thank you one more time.
Yep.
It's been long overdue. And we'll have you back again very soon.
Okay, well, you know, the questions pushed me to show a lot more than I normally would have, but I figure they're there, I'll answer them, you know?
Very good. Very good.
All right,
Thanks.
all right.
Thank you and good night.
Thank
Thank
you all. Have a good night.
Good night.
Thanks.
Over and out from Florida.
Good night, Judy.
Good night.